Hello, my name is JoAnna Simek. I am with Wolf & Company. We're a CPA firm in the Oak Brook area. And today I'm going to be talking about sales tax, and more specifically the Illinois manufacturing exemption and the Illinois manufacturer's purchase credit. Just to give you a little bit of history on sales tax, the reason why sales tax is so important is that almost half of all state tax collections, whether it's income tax, sales tax, property tax, almost half of all of those taxes come from sales tax. And so states really focus on this as an area of revenue. And so it's very important to be vigilant as a company, knowing when tax is due and when it's an item that you might purchase might be exempt from tax. There are 5 states without a sales tax. Illinois, unfortunately, is not one of them, but just as a general point of reference, there are 5 states. The easy way to remember this is a nomad method. New Hampshire, Oregon, Montana, Alaska, and Delaware. Those are the 5 states that do not have sales tax at all. When it comes to Illinois manufacturing, there's really 3 important key questions that you have to ask yourself before you can decide whether something is taxable or whether something is exempt. And the first question you have to ask is, where is it used? Meaning, where in the manufacturing process is it used? Or maybe it's not used in what is called the manufacturing process in Illinois. The second question you have to ask yourself is, what is it? What are you buying? Is it a good? Is it a service? Is it maybe something else? Is it neither a good or a service? And the third question you have to ask yourself is, how is this being used? Not only do we have to know where and what it is, but we have to know, okay, now what am I doing with it as a company? How am I using this product? And really we have to answer all 3 of those questions before we can really determine whether something you've bought is taxable or exempt for manufacturing exemption purposes. The manufacturing exemption is very specific in Illinois. Manufacturing, as it's defined for sales tax purposes, is not necessarily what most people think of as being manufacturing. A lot of people in the office think, oh, everything that's behind that door is manufacturing. Well, that may not be the case. Manufacturing is very strictly defined. So let's start here. Manufacturing begins, the very first point of production is where what they call manufacturing begins. And we're going to talk a little bit later about what that means, first point of production. And it ends as soon as goods are completed and ready for sale. And typically this means that they are really essentially could be shipped out at that point. And usually this excludes activities such as warehousing or distribution or anything like that. That might be, something that you do internally, just kind of manage your finished goods inventory, but really has nothing to do, the goods could go out today, tomorrow, next month. They're done, they're finished. So kind of the places where we have to be careful about where manufacturing begins and ends is inventory. When you have just inventory storage, if you're not doing anything to that inventory, that is not going to be included as the first point of production. The first point of production really needs to be as soon as you start doing something to your inventory, to your product. The other thing to note about manufacturing exemption is that the product movement from when you take something out of inventory and move it into your first point of production is not considered part of the manufacturing process. You and I might think of it, okay, I have to manage my inventory, I have to put it into the process and everything and get it started. But when it comes to this very strict definition of what is manufacturing for purposes of this exemption, that activity of moving it out of inventory until it hits your first machine doesn't qualify for that exemption. Not until you actually put something in a machine or actually start doing something to it does it become manufacturing. And one example that I like to use is one of a quarry manufacturer. A quarry manufacturer, they have rocks that are underneath the ground. And what happens is they will put all of this rock, they'll put explosives in it, and then they'll blow up the rock until it becomes, big piles of rocks at the bottom of the quarry. Well, the question for most companies is it the big pile of rocks at the bottom that is your inventory? Or is it the rocks as they lay in their natural form under the grass, and that activity of blowing them out of that wall of rock, that is considered doing something to your property? In Illinois, the answer happens to be that the inventory is the rock as it is in its natural state. So the activity of doing something to it, making this big wall of rock into bigger boulders, is a production and therefore a manufacturing exempt activity. But it's just something to think about, when you're looking at your inventory. What you may call internally as inventory doesn't always mean that that's purely inventory for sales tax purposes. So it's important to kind of look at the fine nuances here. So I have here a diagram of kind of a visual of the manufacturing exemption as it kind of relates to some of these stages in the process that I've been talking about. The first is inventory, storage, and control, and then the movement of the product to begin the manufacturing process. That's what we would call pre-production, and that is taxable. That is beyond the scope of the manufacturing exemption. And then again, the process of manufacturing, anytime you're doing something to your product, that's considered exempt. And then the product movement, after you finish processing, literally as soon as it's done, it comes off the line, it's ready to be shipped, that is considered post-production, and that would also be beyond the scope of the manufacturing exemption. That's going to be a taxable part of the process. The other thing to note too is the manufacturing exemption is not it's not complete in and of itself, meaning there are things that you use within your manufacturing, within this definition of manufacturing, there are exceptions to the exemption. Those are things that would remain taxable. When it comes to the manufacturing exemption itself, the question is, okay, now that I'm within the manufacturing scope, what is taxable, what is exempt? In order to qualify for the exemption, it has to be primarily used in manufacturing. And this means that it must be at least 50% used in an exempt manner, meaning it's more than 50% used in the manufacturing process. One good example of this are forklifts. Oftentimes companies use forklifts in inventory, they use it in receiving, they use it in, to move product from one workstation to another workstation. They may use it in shipping and warehousing. So you may have a fleet of forklifts that are kind of all over the plant used in a multitude of ways. And what you have to look at is whether that forklift is used more than 50% of the time within our strict definition of the manufacturing process. Manufacturing equipment used in production includes dies, tools, molds, patterns, and really any other attachment to machinery, anything that makes the machine work and run. It also includes chemical catalysts that act directly on the product. So you may need a chemical to use as a reagent to cause a change to either texture or temperature or anything that relates directly to the product. Any types of those chemicals are also qualifying for the manufacturing exemption. And a lot of people find this very strange because it's not equipment. A chemical is, usually, in liquid format, but it is considered equipment for purposes of the exemption. One other area that's really important to note is that repair and replacement parts for exempt equipment are also exempt. This is something that a lot of people miss. They don't realize that all their repair and replacement parts, as long as it's for exempt equipment, is also exempt. Computers and software to control exempt equipment also qualifies. So you may have CAD/CAM software, a lot of machinery these days come with software that have to be mounted on a computer that may be provided by your equipment manufacturer, but those are also exempt from sales tax. And then the other major thing is that machinery equipment that you use to repair your exempt machinery equipment is also exempt. So, for example, you may maintain an in-house repair shop. Well, any machinery and equipment that's in your in-house repair shop, for the most part, is going to be repairing exempt machinery and equipment. So that would also qualify for the manufacturing exemption. Quality control equipment is also a qualifying item, and any temperature control for the product is also qualifying. So you may have certain temperature requirements if you produce a refrigerated product or a product that needs to be heated for any purpose. That type of control also qualifies for the exemption. So that's quite a few things that are exempt from tax. It sounds like a pretty good list, but there are a lot of things that we have to be aware of that do not qualify for the manufacturing exemption. And you may be using these within the scope of your manufacturing process, but because of what they are, they don't qualify for the exemption. So let's take a look at some of these. The first big one is consumable supplies. So these are adhesives, lubricants, anything that is consumed within the manufacturing process. A lot of times these are products that are just used to keep the equipment up and running. Cleaners for the equipment. Maybe you have to turn over between shifts or between products. That type of product, those consumables, those supplies are not exempt for manufacturing purposes. The other big one are hand tools, anything that is literally hand powered. So common examples would be screwdrivers, hammers, anything that really doesn't get powered by electricity does not qualify for the exemption. And then the third big one is real property, machine foundations. You may have to put in a concrete slab on which to mount your machinery because it needs certain weight support or it needs to be stabilized in a certain way. That type of product is not considered part of the machine. What it is actually considered is real property. So you may pour it yourself, you may pour the concrete yourself, just know that that's something that you would need to pay tax on. Other items are maybe equipment, they may be consumables, but they're not exempt because of how they're used. So for example, pollution control equipment. Anything that's pollution control for wastewater or dust bags, any types of filters or anything that you need to use to keep the air clean, those are not considered part of the manufacturing exemption. Even though they're attached to exempt machinery, even though you're using them very clearly to produce your product, that type of pollution control for the breathability of your workers, to clean up equipment for OSHA requirements, those are not qualifying purchases for the manufacturing exemption. Communication systems, anything that you use, whether it's radios, handheld radios, speaker systems, those types of things, not part of the manufacturing exemption either. Research and development is also not qualifying, so you may have a whole department dedicated to developing and coming up with new and better products. Well, unfortunately, Illinois doesn't give you an exemption for that either. And then safety and security, any type of security system that you use for the plant, safety apparel, this is a really big one for a lot of companies. You may have earplugs, safety goggles, special shoes, hair nets or anything like that. Those, again, are not qualifying for the manufacturing exemption. And then the other big one to note is temperature control for people. So temperature control, when it comes to the product, necessary and essential to the product development is exempt. But if it's just temperature control because you want to keep your workers in a comfortable working environment, doesn't qualify for the manufacturing exemption. So what does that tell you about what Illinois thinks about, individuals? But unfortunately, that's just how the exemption works. Okay, so now that we've talked about the manufacturing exemption in kind of broad terms, I want to talk about the Illinois Manufacturers Purchase Credit. And this is something that is used by a lot of companies to help mitigate some of the sales tax burden on a lot of the items that I mentioned, which are taxable. For example, anything that's used in inventory, anything that is used in finished goods, warehousing, distribution, items that are consumable supplies, safety supplies, all of these things that I already mentioned already, these are taxable. They are not within the scope of the manufacturing exemption. The Illinois Manufacturers Purchase Credit is designed to offset some of these sales taxes that are due. It's a really great benefit. I find a lot of companies are either underutilizing their credit or they're not taking any credit at all. And so being educated about how this credit works is going to be essential to helping you save some real tax dollars. So there are two components to the credit. The first component is generating the credit. You have to find a way to generate these credits, and then the second component is how you actually use the credit, what I like to call monetizing the credit, turning this credit you've generated into real tax savings dollars. So let's talk first about how you earn the credit. Credits are earned on purchases of all exempt manufacturing items. So all of the products, all of the equipment that I talked about that was already exempt, anything that's 50% or more used, anything that's greater than 50% used in the manufacturing process, any of your repair parts, any of your in-house repair shop that may be used to repair exempt machinery and equipment, all of those things on which you did not pay any sales tax or should not have paid any sales tax, that is what you base your credit generation on. And what you have to look at too are a couple other little points. One is if you paid for labor to have a piece of equipment installed, or you pay for repair labor to have your equipment fixed, that labor charge is not a part of the credit generation base. The other thing that's excluded are shipping and freight handling charges. So we have to look purely at the cost of the equipment itself. You have to take out all the kind of labor components that may be in there. And what you generate is a credit of 50% of the state sales tax that would have been paid if you had to pay it. Okay, so in simpler terms, it is 3.125% of the total amount you spent. It can be confusing because most people think, oh, I have to pay tax to generate a credit. This credit doesn't work that way. You just get a credit for spending money on exempt items. So what you want to look at are all your purchases for the year of capital equipment. Repair parts is a huge area. Not every day are you going to go out and buy a piece of machinery that's $1 million, but you might spend on a regular basis $100,000 or $200,000 fixing and maintaining and keeping up all your equipment in working order. So it's really important to look at those repair parts and replacement parts to make sure you're capturing all of your credits. Let's walk through an example. So in this example, you bought a piece of equipment for $100,000, and the company came and they installed the equipment for you. They charged you $5,000 for the installation, and then they charged you a $500 shipping charge to get the equipment to your location. So the total invoice was $105,500. Well, remember, the installation charge, that's labor. That's not for the equipment itself. So that is not part of our credit base. And the shipping charge is just simply a shipping charge, and it doesn't qualify either. So the total credit you earn is 3.125% of the $100,000 pieces of equipment that you purchased. So in this example, you generate a credit of $3,125. Most companies will find that they have more credits than they can reasonably use. Again, it's hard to make general statements about how much credit any given company can earn. There aren't even solid trends and patterns among companies that are of similar revenue size. It's really driven by how much you spend in equipment purchases, and that again varies from company to company. But it's really important to make sure that you are capturing these credits, because I have found in my experience that most companies have more credits than they can possibly utilize. So if your company is in a situation where you don't have enough credits or you're running out of credits, then I would encourage you to take a closer look and make sure that you've looked at all the areas where you can generate credits. Okay, so the second part of this is using credits. And the use of the credit is against all of those items that I talked about before that are taxable. So everywhere where you are supposed to be paying sales tax, you can use your credit to offset the state rate that is imposed on those purchases. You are still required to pay the local tax. So for example, you may have an item that is $100. You bought some safety goggles. You spent $100 on it and your vendor charged you $8 of tax. So that's an 8% sales tax rate. The Illinois state rate is 6.25%. So you would be able to offset $6.25 of the tax, and then you would only owe the incremental $1.75 of local tax that your vendor has charged you. So immediately, anytime you have a credit, you're able to save 6.25% on all your taxable purchases. So just to go into a little bit of what other types of purchases. So again, it's pre-production, it's post-production, it's what the technical term is production-related purchases. That is really where you're gonna save a lot of money. I find the biggest area for most companies to save money in this, it has to do with purchases of safety equipment. They have purchases of coolants, lubricants, oils, grease, solvents, adhesives, all of these things, cleaners, that's a big category. All these types of consumable items that companies use frequently and a lot of times in great volume. It's also can be used against any fuel oil, any kind of artificial gas. So if you have a welding department that you use and they use a lot of gases in that process, well, normally those gases are taxable, but you can use your manufacturer's purchase credit to offset those taxes. You may have forklifts that are running around your plant. They may be propane powered, they may be gas powered. The tax that you pay on that can also be offset by the credit. Hand tools, something that we talked about earlier, which are taxable items: wrenches, pliers, hammers, screwdrivers, protective apparel, gloves, hats, coveralls, goggles, anything of this nature would normally be taxable, but you can use your credit to offset the tax you have to pay on it. Forklifts, hand trucks, pallet jacks, anything like this that might be used in the warehousing, finished goods inventory. Maybe you didn't meet that 50% test that we talked about earlier, so you might have a fleet of forklifts, but you can only figure out that you're actually in manufacturing maybe 20 or 30% of the time, so they don't meet that 50% test. So those are forklifts that would be taxable, but you can use your manufacturer's purchase credit to offset the tax here. Storage racks, two-way radios, really literally anything that is related to your manufacturing process would become eligible for use of the credit. So the credits that you earn are good for 2 years. You report these on a calendar year basis, so the January through December purchases that you make for the year, that reporting is due on June 30th of the following year. There are no extensions allowed for the filing of these returns, so you want to make sure you get them in on time. You can go back and amend them later if you find out for some reason what you reported wasn't 100% accurate. It's okay to use estimates and go back and amend to get a more accurate number. But you do want to make sure you meet that June 30th deadline. And if you don't file those forms, then you lose the credit altogether. And these credits are good for 2 years. So what you will have generated by the end of December will expire 2 Decembers from that date. One other thing that I want to mention about the credit, that's kind of a neat way to use it, is against audit assessments. So let's say you win the audit lottery and the Illinois Department of Revenue decides they want to come and audit your books and records. And if they should come up with an assessment, you can use this credit that you've generated to offset some of that liability that they come up with, which is a really nice thing to have. It's all the more reason to be filing and generating as many credits as you can, because it is what I like to call audit insurance. It can really help save you having to cut a check to the department for, you know, tens of thousands of dollars because, you know, maybe you didn't think you needed the credit before. So there's a lot of different benefits to the credit. If you're not currently utilizing the manufacturer's purchase credit, I would strongly encourage you to start looking at it. I have found that in almost every case it does benefit the company to have it. Well, I hope this was a nice summary of manufacturing exemption in Illinois and also the Illinois manufacturer's purchase credit. If you do have questions on sales tax or anything related to Illinois, please feel free to give me a call or shoot me an email, and my information is available.